shout out to Mark Carney, one of the best statesman-like speeches we've heard in decades. The Trump administration, desperate for wins on all fronts when it comes to affordability. Gold has way overshot any kind of model that we have.
On this episode, we speak to David Picton of PICTON Investments. He's the biggest hedge fund manager in Canada and a prominent figure on Bay Street. He shares his exclusive insights on the new investing world order. Does the U.S. underperform global markets? What do you think the threshold is for the bond market to kind of tip over?
There's about $2 trillion worth of supply that has to be made up somewhere. But who's going to absorb the impact of this massive financing that has to take place?
What is your view on the Mag 7? Are you willing to short those 7 stocks? When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof, from tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement. They bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Hey everyone, welcome to a new episode of In the Money with Amber Kanwar. We're still doing our swag competition. Anywhere you're listening, Apple, Spotify, YouTube, in the comments, if you've got an idea for a funny meme, drop it in the comments. We've got some good ones. One of the good ones is a baseball hat that says market cap, which I think is cute. Having a free cash flow sweatshirt. We have the EBITDA sweatshirt, but there are many people that think free cash flow is more important. I think this one's my favorite. Free Jerome Powell. Get a mug that says Free Jerome Powell. Or I like this too because it's punny. Liquid assets for a coffee mug. What do we have? Oh, Jillian's not here. We have a liquidity provider mug, yes. But I like liquid assets. So do you have a favorite? I think Free Jerome Powell. Okay, she likes Free Jerome Powell. I should put a poll together at some point. I will do that. I will put a poll together and you guys can vote and then I'll make it. But the competition's not over. If you think you can top any of that, drop it in the comments. On this episode, I'm actually really excited. We've got David Picton. He is one of the biggest hedge fund managers in Canada. Actually, I think as an independent, he is the biggest hedge fund manager in Canada with over $16 billion in assets. He's a large figure on Bay Street, and he looks at the markets in an interesting way. And I think now is a good time to talk to him because I'm sure a lot of people heard of Prime Minister Mark Carney's speech in Davos, where he talked about the new world order. And I think that speech will go down in history as kind of a seminal moment of everybody understanding what is really happening in the world. And for several years, David Picton has kind of been on about a new investing world order. And the two are colliding. The way he thinks portfolios should be set up and the way the world is shifting kind of meet in this podcast. So if you're looking for ways to understand, well, what does this new world order mean for your portfolio? This is going to be a great episode for that. And they don't ever like to give their investing ideas. They're a hedge fund, they're secretive, but I pried it, one idea. And then I think we actually got a bonus idea and it's all the way at the end of the episode. So you have to listen all the way through. Let's get into it. David Picton, thank you so much for joining me on the podcast.
Pleasure to be here, Amber.
So you have the honor, you're the biggest hedge fund in Canada.
Yeah, I think so.
$16 billion around there in assets. and some really explosive growth. But before we talk about that, and I promise we will, you do really kind of loom large on Bay Street. And I think I always love to know, like, what makes you tick, what got you started in finance, and what, like, part of your early journey sort of informs where you are today.
Well, I was incredibly fortunate. I grew up in a small town in British Columbia, had no idea what a hedge fund ever was, or even that this business existed. Went to UBC, and they launched the UBC Portfolio Management Foundation while I was there. So I got to be in the inaugural year of the program, which got me access to a job in Toronto for the summer, some mentors in Vancouver that were just absolutely amazing, and basically access to this hidden world that I never knew existed. Got hired out of UBC to work at RBC Dominion Securities, as it was called at the time, as a kind of trader, salesperson, bottle washer, go-getter of lunches for people. And then from that, somehow got hired to be a quantitative research guy in Toronto. And that is where the real journey into how stocks and markets worked for me began. And here I am as a result of that.
And quantitative, as opposed to qualitative, that you've got the analysts who are meeting with companies, modeling out, a company's earnings growth and buying that way. Quantitative, you're taking almost a 30,000-foot view and saying, how do all those little actions fit together?
Yeah, we literally had probably as much computing power as you have in like an old generation of an iPhone from 10 years ago. But from that, you were able to access as much data as you could. We actually had to build our own databases by hand back in the day. And then you tested out different factors. Those factors like estimate revision or earnings surprise or value or growth or predictability, those are staples of the business today. But 30 years ago when we were doing this work, they were kind of cutting edge stuff. Once I had an understanding of positive fundamental change and how impactful it was, I was able to parlay that at a startup mutual fund company called Synergy Asset Management that CI eventually bought. And then from there, we kind of tried to move those into the hedge fund world. And that started back around 2005.
When people think of hedge funds, if they're not invested in them, you might think of that show Billions, where it's like very high stakes and you're trying to get an edge with specific companies. But again, you're coming to it with this quant perspective. And I always find I'm always trying to pin you down on stocks, and you're always brushing me off and saying, Amber, that doesn't matter.
Compliance,
Yes, yeah, and compliance. But I do get the sense too that, of course you guys do your work on stocks and try and find an edge there. But like where you're super passionate about is not necessarily the pure stock picking. It's thinking about it from like a second level.
I had a big epiphany around 2018. We started to delve into, we had a research team that spent about 18 months looking at how do endowment funds and, pension plans, how do these guys manage money? How do they allocate capital? And we came to this idea of the total portfolio approach. In other words, you don't have to segment your stocks and your bonds and your real estate and your alternatives or whatever into different categories, but rather you should look at how each individual security impacts the total risk and reward of the entire portfolio. And so when you start thinking about it that way, stocks or the stock market or bonds or the bond market or commodities or the commodity market just become simple return streams that you try and combine as efficiently as you can. And the very best, pension plans in the world, Canada Pension Plan, for instance, work on this idea of the total portfolio approach. And so it kind of frees you up not to think of so much about the individual securities, which is an important part of our business, but rather to think about how each of the returns impacts your journey to reach your financial goals. And that was big for our business. It changed everything in terms of our mindset.
But that also came at a time where getting access to those strategies was becoming more accessible to retail investors. We just did a whole special on alternatives because now more than ever, it is a strategy that's available to everyday investors.
The democratization of the alternative space was an important development. Canada has lagged dramatically behind the rest of the world in terms of the average investor's exposure to alternative products. It's changing now, but for a number of years, and we don't have to go into all the different reasons for that, we were very much in the 60% equities, 40% bond mindset. And quite frankly, that was a great place to be. From the peak in interest rates in 1982 to the bottom of them in 2022, when you had stocks and bonds in your portfolio, they acted like diversifiers to each other, and they both generated amazing positive return streams. The outcomes were significant. When you get into an environment where stocks and bonds start acting the same, like they did in 2022, when inflation expectations are rising, you start to lose the diversification effect, and your overall risk in your portfolio jumps dramatically. And so we like to position alternatives either as ways to enhance your stock and bond exposures, i.e. through private equity or private credit, or ways to diversify those exposures through alpha-based strategies or through commodities or whatever the case may be.
I was talking to a friend who worked in private debt, and she was shout out to Anya Ray. She was actually looking at what was the origin of 60/40. Like, did it make sense, or was it that's all that was available at the time, right? So you come out with the strategy of 60/40 because that's all that was available to retail investors is stocks and bonds. And now you're living in a world where there's more available.
Yeah, I think if you look back at the 150 years of capital market data that's available, and you looked at just the long-term returns of equities, they're approximately 9%. And if you looked at the long-term returns of bonds, they're about 4.25%, somewhere around there. But the beauty was, and maybe it was random, maybe someone actually did the math, but when you put it together in this 60/40 proportion, you got almost the equity returns in terms of your overall performance, and you had almost bond-like volatility. And so this model has served investors incredibly well for so long. But in environments where, as I said, inflation expectations are changing or valuations are incredibly high, the need for diversification of those two return streams becomes paramount. And that's where I think alternatives can play a massive role.
And your split is not 60/40, it's...
I like to coin it the 40-30-30 model. You should absolutely have equities in your portfolio for the long run. And if you had a 100-year horizon, maybe you only owned equities. But the reality is, especially as we get into retirement, our time horizons shrink. And so we have to find ways of getting those kind of returns without taking on the big drawdown risk that can really punish your overall retirement savings. So we go 40% equities, 30% in traditional bonds, and then we look at this 30% bucket of alternatives. And we break that into three. Enhancers, i.e., they're going to get like a private equity or private debt exposure. Diversifiers, like say an equity market neutral or an arbitrage strategy, which acts completely different than your stock and bond portfolio. And inflation protection. And that generally kind of gets you into the commodity space to do that.
Now, what's interesting about this is it's all kind of hitting at the same time. Like your Picton is kind of in this story. Fine, you're talking about this new world investing order. At the same time that, Mark Carney was just saying this week, there's a new world order. So at the same time that you're advocating for, you need more other in your portfolio than just equity and bonds, like that other portfolio seems to play a greater role in whatever this new world order looks like.
Wow, there's a lot there to discuss. And absolutely a shout out to Mark Carney's and his speech at Davos. I think that will go down as one of the best statesman-like speeches we've heard in decades from a global leader. It was profound and impactful on so many levels. But you're absolutely right. The world has changed, and there's all kinds of trends that have developed as a result of that. There is massive amount of monetary policy stimulus occurring around the world to kind of buffer economies. There is massive amounts of fiscal stimulus taking place to rebuild infrastructure for new trade routes, for the AI boom, for a whole host of different things that are going on. And so it's not often where you have inflation above trend and two massive stimuluses occurring at the same time, plus let alone this whole capital spending around the AI development that's taking place. And so we've been used to a market that's been driven by the big names. In the US, the Mag 7, absolutely stunning performance of great companies. And the rest of the kind of 90 percentile of names have kind of been left behind in this move. When you get economic tailwinds developing around the world, you start to broaden out the number of companies that can participate. And stock selection and alpha-driven strategies, I think, become a really impactful way to play that trend.
And I think it's important, like, not to beat up on the hedge fund industry, but like 2025, was a great year for investors, but it's almost bad for hedge funds because everything does well. Like, I'm a genius in my portfolio and I don't have, an ounce of the skills of people who've dedicated their lives to this because everything is just going up. You're at worst case, you're going up 20% in the US and doing better internationally. So most hedge funds underperformed.
Not only that, there, as you get into the later stages of a kind of an equity market cycle, you tend to see speculation really kick into gear. And hedge funds are notorious or maybe famous for going after companies that are inflated, speculative. The underlying business fundamentals aren't that great. The stock prices are high. But in a year like 2025, you are absolutely punished by that. So the short side of the equation that you use to help hedge your overall exposure to the equity market was actually much more painful than the long side in many cases. And that's just the reality of being a hedge fund manager. You have to deal with that short squeeze from time to time.
I think that's a really interesting point. As much as the markets ripped higher, it wasn't like a 2020, 2021 where we're putting money into nonsense.
Broad market rally. Yeah.
It's crypto is not done well. There's, all those SPACs. I don't know, people say SPACs are coming back, but the SPAC, there wasn't that kind of frenzy. What does that tell you about the longevity of this market cycle?
Well, I think there is longevity, but I think it's going to be a different kind of exposure that works. We started to see this in the tail end of 2025. Obviously, everyone can look at the gold and the silver tape and say, wow, that's just incredible, the moves that have taken place in the last 6 months. But as the economy broadens, as commodity trends get more established, as emerging markets start to do better, you start to see stocks that have been left behind for literally a decade start to act again. And that's where the opportunity is. And as you mentioned earlier, that speculative froth has been in names where there isn't really a lot of great underlying business fundamentals, but there might be a theme that they could play. And so you could at some point in time get the rationalization of that speculative bubble stuff at the same time that some of this kind of quality value stuff that's been left behind starts to perform. And that could be just a dramatic shift in market sentiment and hopefully a really good environment for hedge fund managers around the world.
So your outlook is calling for a broadening of this rally, looking at areas that have been left out in the previous rally. And we're starting to see that show up already in a big way in 2026. One of the areas is in small caps. There's been a lot of head fakes in small caps.
Yes, there has.
Is this another head fake? And if not, why?
I think that the small cap market in particular is most dependent on economic growth and acceleration. A lot of these are not scale businesses. Their margins are tighter. But as the revenue line starts to develop, a lot of it falls to the bottom line. And so if you start to see this broadening economic growth, because all these tailwinds lead to some acceleration that's out there, there is a whole host of companies that have a really bottom line impact that's felt almost immediately from that. So you start to see that in some small cap areas. You also start to see it in some of the early cycle areas of a market. Autos have had a pretty good move already. Generally, housing has a good move, and there's a little asterisk we can talk about on that front. Maybe the transportation area starts to act a little bit better. Maybe some of the industrials that aren't just related to the AI boom, they start to kick into gear. And that broadening is what we're kind of hoping, and maybe not hoping, we're actually betting on takes place this year.
Okay, so I think this is a good place to talk about what is going on with the economy, because you look at the headlines and it doesn't seem great. And you can pick your data points that suggest it's also not great. But then you pull the lens back, US GDP, is it going to have a 5? A 5 handle.
Theoretically.
Earnings growth has been tremendous. It hasn't fallen out of bed. As the quant guy, where do you find your signal from?
Well, first of all, there is this thing called the K-shaped economy taking place today. So we had all kinds of policy uncertainty in 2025, yet the volatility was incredibly low. And in hindsight, probably the people that navigated the best were the retail investors, especially in the US, that just bought every dip along the way.
We've been trained.
They have been trained and have been rewarded relentlessly for it over the last number of years. So you get this environment where if you were an asset owner, if you had your own home, if you were invested in the market, if you were in the AI-related industries and some of the ones that support them, you've had just a tremendous 2025, and your wealth has been incredible. Since the beginning of COVID, there's been about $60 trillion worth of new net wealth created just in the U.S., let alone what's happened around the rest of the world. So there is a powerful consumption impetus from all of that net wealth sitting there. If you are not in those industries, if you are in the lower income cohorts, it's exactly the opposite. Your job prospects have weakened. There is a threat from AI that might take out the traditional jobs in like driving trucks, driving cars, et cetera. That's like literally around the corner. If you're coming out of school into this new AI environment, unemployment rates are higher than they've been. So you've got this one group that's completely missing out while this other group's completely benefiting. And so that's caused the Fed to start to err on the side of employment other than inflation in their dual mandate. And so they're putting stimulus in when a lot of people don't need the stimulus. And that's where you start to see an acceleration take place. And that's where you start to see maybe some inflationary pressures, but you also start to see a broadening of the amount of people that participate in the economy.
And again, your view, I think, is that inflation remains elevated above target for a period of time. I don't think you're betting on runaway inflation, but you're clear-eyed about the fact that inflation didn't go back down to zero, as everyone told us they would.
Yeah, absolutely. Again, it's very unusual to see the Fed cutting at inflation well above target. And the most important tell for this year, and the thing that we're spending the most time focused on as a risk factor, well, there's actually two. First of all, our view is somewhat consensus-y. We're the first to admit. And valuations, especially in the big top decile companies, already reflect this view. So you have to start getting into companies that are a little less known to kind of capture some of the benefit. And secondly, we do a lot of work tracking flows and positioning between all of the systematic strategies like CTA trend following funds or risk parity related funds that rely on low volatility or volatility control funds. They're all invested. Cash on the sidelines, according to Bank of America's latest survey, is the lowest it's been in like 2 decades. So there is a lot of already betting taking place on this scenario, and we might need to shake that out. And one of the things that might shake this whole thing out is what's happening in the bond market. Because while the Fed is cutting rates, what normally happens is the bond yields tend to fall. There's a reason to cut rates. Things are getting softer. The bond market sees that. In this case, the Fed's been cutting rates and bond yields are higher than when they started. And that's very unusual. And then you look around the rest of the world, you start to see bond yields are actually going up in many regions. They're going up in Japan. They're going up in Europe. They're going up, obviously, in the U.S. And so you start looking at that. That's a bit of a kind of a head scratcher. And then you look at Japan in particular, which runs at about 260% debt to GDP, where they've been trying to get out of the deflationary spiral for like 3 decades. And they have. And all of a sudden, they have to raise rates while the rest of the world is cutting rates. And the very interesting thing that's happening in the background is that if you raise rates and everyone else is cutting rates, generally you attract flow and your currency goes up. The exact opposite's happening. The yen is falling in value while this is occurring. So is the market starting to sniff out that something's not exactly right with this scenario? Are they sniffing out an inflation surge? Are they sniffing out that there's too much bond issuance that's going to take place? And so if interest rates start to go up against the backdrop of some pretty high valuation already, that's where our scenario is at risk. And so we're really watching this Japanese thing to understand or trying to understand what's going on there because it's not consistent with our view.
I think that's important, and it might seem like in the weeds to talk about bonds and yields going up. But I like to say more powerful than any Tomahawk missile is the bond investor.
Yeah,
because they'll put an end to policies that don't make sense or that step too far, and they're called bond vigilantes.
Absolutely.
And it looked like maybe they were creeping up a little bit in the U.S. and in Japan. They want to do fiscal stimulus on top of
they're
all.
Trying. Well, Japan is almost being like England.
Yeah.
In that, how many, like 5 different prime ministers in whatever short period of time that they've had. One of them Elizabeth Truss tried to do, some sort of stimulus package, and the bond market punished her right away, and she's no longer in office.
And then now it's called the Liz Truss moment.
Absolutely.
That's how I think, what was it, 45 days? Maybe less than 45 days.
And Japan trying to do the same thing, and the bond market literally went up 25 basis points in one day alone, which is like, wow, this is not good.
Let's talk about the so what of that, because we've seen the bond market say, I'm ready, and then whoever it is backs down and things start to calm down. Like, what do you think the threshold is for the bond market to kind of tip over? And then, like, where do investors go? Like you said, everyone's fully invested, right? Like, where do they go? Don't they need a return somewhere?
That's a great point. I mean, look at your starting point. As I said, we've got a constructive tailwind backdrop, but we fully acknowledge that the major indices are trading at valuations. Like if you looked at in the US, the market cap of the stock market, and you compared it to the size of the economy, it's at an all-time high. Like just forget about valuation. Just the size of the market relative to the size of the economy is massive. If you look at the top decile of stocks relative to the bottom, it's at an all-time widespread. If you look at valuations using like the Shiller PE, where you look at the last 10 years of average earnings on the S&P, and then you compare it to the current PE, that looks like it does in a bubble. If you look at the bond market, there's basically not a lot of term premium that needs to be built in, and real rates are actually, fairly high. If inflation starts to go higher and you start to build some term premium against the backdrop of who's going to buy these trillions of dollars worth of bonds that need to be issued, and you start taking rates higher, that's when you can start unraveling this whole thing. So bonds are critical to this outlook.
Are you willing to be short?
And we are always willing to be short, depending on the product in question. So if you are worried about stocks, and if you're worried about bonds, and most importantly, if you're worried about the correlation between them, i.e. they're both acting the same, and your total portfolio risk is going higher as a result, then you have to look for alternative return streams that look different than stocks and bonds. And that feeds exactly into better portfolio construction, and that's what our firm is focused on.
Look at that. You brought it back.
I believe in it wholeheartedly.
What I wanted to hear is, of course, I'm short. I'm calling for a 50% drop. Okay, but you brought it back to portfolio construction. And one of the elements in that other bucket is gold, is commodities. And so, I asked, like, where else do you go? If it's not stocks, it's not bonds. People have already been piling into gold and to silver. What do you make of that? Again, as a student of history, you look at how things typically go together. Does the gold rally make sense? What is the signals? People think, oh, it's a recessionary signal, but we've just talked. The data is not saying recession at all. So what is it?
I was at an investment dinner last night. Different perspectives from different fund companies, PMs, and pension plan guys. And a number of people have these different models where they try to predict the price of gold based on real rates or changes in this or changes in that. And basically everyone said, well, gold is way overshot any kind of model that we have. So I think it's very simple. When you wake up in the morning, if you have a lot of wealth, you wake up in the morning and you go, do I feel better about the prospects for my currency and the leadership that's in charge of it? Or do I feel worse? I think it's as simple as that. And I believe that over the last year in particular, people have begun to feel worse about that. They feel like, the central banks are pumping a whole bunch of money out there. The overall leadership, and we know who some of the characters are, they don't seem to care about their balance sheet at all. And so they're looking for ways to protect their purchasing power, to protect their money in case of something crazy happening to their currency. I think that's as simple as it happens right now. And it's occurring all around the world. We had the major moment when Russia went into the Ukraine. Their assets were seized. Mm-hmm. It's almost from that point in time where you could see central bankers around the world, funds saying, is this money actually real? If someone can just take it from me, what can I have that no one can take from me? And that began this idea of we're devaluing or debasing fiat currencies, and we're buying things that are hard assets that we can hold. And I think that trend is important trend. I think it's probably got overblown in the short run. I think it's like we've gone parabolic on this front. And if there is any sense that things actually get a little bit better, that maybe the budgets aren't as bad as people think, maybe the central banks are a little smarter than we think, that would be a big bid to the gold and silver trade suddenly kind of diminishing.
To diminishing.
Yes.
What's your risk? Like, should I be in gold or not, David?
I think you should have. I think in this environment, you should absolutely have some inflation protection. And that would include a whole basket worth of commodities, not just gold and silver.
So there's the metals, and then there's the stocks on top of that. And maybe you can bring in like how you think about valuation. But these gold stocks, these silver stocks are up way more than the underlying. What do you make of that? What's the signal from that?
I looked at, as a quantitative research guy, we've looked at every which way to Sunday to try and model commodity stocks, in particular gold and energy stocks. And the reality is that they are driven by one thing. What's the price of the underlying commodity doing? And some stocks have more leverage to that because they're a high cost producer, say. And so, they have a certain kind of margin, but as soon as the gold price goes up, it all falls to the bottom line. Their margins improve dramatically. They have more leverage, as people think. And so it's just a matter of the underlying commodity and the degree of beta you want to take to that underlying commodity. So I don't think there's any magical in that they've outperformed. It's just they are really good beta exposures to that.
Okay, so let's talk about energy then, because energy hasn't participated, that crude hasn't at least, but a lot of these energy stocks have behaved a lot better.
Recently, yes.
Recently. What's your explanation for that? And I think people say energy is late to a commodity party, but eventually joins.
The gold thing is a kind of a debasement related trade. It's about what people believe as opposed to what the underlying fundamentals that drive it are, because we don't really use gold for much other than as a store of value or some jewelry applications. We use energy every single day. And so maybe what's happening here is the market's beginning to anticipate that in spite of what looks like massive amounts of supply available, maybe even Venezuela coming back online, that the economy is going to start absorbing some of this supply. And that maybe these companies that have been down and out for a little bit provide really good leverage to overall economic growth improving. I kind of think that's what's happening here in the energy stock trade at this point in time.
To kind of hedge against that, what do you do? You mentioned this earlier, like how political volatility, and you can actually measure that, and actual volatility have become sort of decoupled. How do you just ignore political events, like in some of your trading strategies, event-driven strategies, or whatever it is? Like, how do you actually use some of this?
Well, there's a lot of different ways you can hedge portfolios. You can literally go short stocks that are related to some of the things that you're long. You hope to take out the market risk and then just take advantage of the stock selection risk or the idiosyncratic returns of one security versus another. But there's also ways to take advantage of volatility markets. So when volatility is extremely low and yet you see like policy uncertainty is kind of high, that's a very good environment to do simple hedging strategies. I'm going to buy some puts on the overall market as a hedge to give me further downside protection. And so when vol is really low, you buy puts. You can even buy volatility itself. And when vol is very high, you want to try and do the opposite strategy. Because generally when vol is really high, you've gone through something bad. There's no longer time to probably hedge. It's too late. You might as well start trying to increase your exposure. And you can use the opposite of volatility to try and do that. So you either hedge it at the individual security level with other securities, or you hedge it at the maybe portfolio level with these accesses to put protection.
And I mean, if you'd done that in the last week or so, that would have been a great strategy.
It was.
Vol was very sleepy.
Yes, it was.
And so if you bought puts, great. That's a way to bet on the market going down. And now volatility has kind of picked up again. But another thing, besides buy the dip, which we've been trained now for 15 years, that is starting to permeate is the taco trade. Trump always chickens out. And that is basically the big bark, minimal bite. Is that a strategy? Is that an investing strategy?
He's obviously been very interesting for markets. I'll kind of put it that way. And maybe there is some method to the madness. In other words, you come out in the tariff trade, you threaten these crazy, ridiculous tariffs that they might have actually just made up using ChatGPT. Like, we don't even know how they got to their numbers. The market gets panicky. They fall. He backs off, and he backs off to a lesser level of tariffs. He didn't back off and say, oh, tariffs are bad. Just backed off to a lesser level of tariffs, maybe even accomplishing his goals. So, for instance, maybe the fentanyl trade has actually been deteriorating as a result of this. Maybe the countries around the world that have ignored their own defense maybe are starting to not do that any longer. Parts of NATO, for instance, have been negligent in that, including Canada. We're no longer doing that, the amount of defense spending we're doing. Maybe and the biggest thing about this is that within the U.S., they have a really strategic sensitivity to their lack of high precision manufacturing. Mm-hmm. China does most of that. China has cornered the rare earths market. So maybe by battling around and doing these kind of unconventional things, you're actually helping to rebalance some of the strategic negatives that exist within their economy. And we may not like the method and the madness that comes with it, but perhaps there is something that's actually happening that's constructive as a result of it.
Now, that's an optimistic way to look at it. Another way would be, yes, and it also creates maybe a more insidious issue for U.S. markets, the so-called sell America trade, where people, whether it's for emotional belief or just the fact that now I can get a yield at home in Japan, or I can get a yield in Canada. Like, why don't I just take some? Like, I've been so indexed to the U.S. for so long. How do you think about the U.S. as a market, which is so dominated over the last 15 years, retrenching and finding opportunities globally? Does the U.S. underperform global markets?
I think the U.S., I think the current policymakers are misunderstanding the impact of being the reserve currency and what a benefit that was to them. Rates were artificially lower because they were the reserve currency, and because they ran these massive trade deficits, it meant that countries around the world had all kinds of US dollars that they had to recycle, and they would just recycle them back into the market. And they funded debt at lower levels than it probably otherwise should have been. And that was just a tremendous advantage to the US. So as you start to decouple yourself from the world, and as you start to reduce trade deficits with certain countries, there are less dollars coming in from those countries into your own, and which means you probably start to lose some of the benefit of those lower than what they should have been interest rates. I don't know that people are going to do so much repatriating of assets. There's some of that for sure, but their own countries are spending like mad too. Their own countries require someone to finance the deficits. And as you mentioned, the yields are getting better in some of those countries. So maybe it's just a matter of, I'll just stick to my own knitting. I think the U.S. is probably going to be short compared to typically, they used to have China buying, they used to have Japan buying. Those countries have receded dramatically. There's about $2 trillion worth of supply that has to be made up somewhere. And so far, U.S. retail investors have managed to, kind of swallow that up. If it gets bigger with other countries having their own priorities, that's where the bond market starts to get nervous. Mm-hmm. And that's what we're watching for. Who's going to absorb the impact of this massive financing that has to take place?
You think that shows up this year?
I think it might be showing up already. Like I said, you've had rates falling in the short end.
This happened last year, though.
It began last year. And again, now you've got this weird thing happening in Japan where their rates are going higher, and now rates are going higher there. And inflation expectations so far are benign, but inflation itself is still fairly high. So yeah, it is a significant risk to this whole thing.
And that's why, again, I'll take it there for you. The other basket does well. Now, I do have questions about that, because if commodities are in the other basket, well, in my equity strategy, I can buy Newmont, I can buy Barrick, and I'm still doing that thing, right? Where I'm getting that
gives you some exposure. Of that for sure. Yeah.
So what's different in that other strategy?
It's just that you get access to the kind of the true drivers of inflation. You're getting direct, say, commodity exposure, whether it's in food. whether it's in, metals, whether it's in gold and silver. Maybe it's even in the ability to short treasuries, for instance, is another kind of hedge. So you're absolutely right that you could magnify it in your equity portfolio. But some of these underlying return streams you can't capture in equities. They don't have like rare earths.
Mm-hmm.
Very difficult to find a rare earth company that's really significant in size that people can trade.
So what do you do?
So we actually have the underlying commodities.
Oh.
Yeah. So we'll have a strategy. We have an inflation protection strategy that actually owns the underlying commodities.
How do you because part of your growth is like liquid alts,
yes,
right? And that's why alternatives have exploded, is because you've added a layer of liquidity. Meaning, before I'd be locked up for who knows how long,
yeah.
And now I should be able to get, what is it, weekly, daily?
In our case, we can offer daily, and if you want to trade ETFs, we can offer it by the minute if you want for these things.
So how do you own the physical stuff and still offer liquidity? Does it constrain your ability, right, a little bit, the strategies that you really want to pursue?
The more out there you get, the more you have to constrain liquidity. But in the case of commodities, you can buy just a lot of futures contracts on these things, which you can literally trade almost 24/7, but you can trade them very quickly during market hours. So when you get into, let's say, equities, that market is so developed that you can easily, in our case, we can easily liquidate a massive amount of our portfolio literally on day one. So we offer daily liquidity because there's no need to constrain people there. As you move down the spectrum into less or more exotic tradable assets, liquidity gets a little bit tougher. And then, of course, as you move into the private equity and private debt areas, liquidity is even more tougher. So really, you should match the liquid alternative and the amount of liquidity you provide to what you're underlying trading. In the US, there's this interesting trend where they're trying to do private equity and private debt in ETF forms that trade literally by the minute. And we'll see how that plays out over time.
How would they do that?
They have someone there that's prepared to give you a bid on the assets. But all of these strategies generally work well in an environment where everything's buoyant and liquid and everyone's confident. We'll see how they work in an environment where people are a little less so those things, if we ever get one of those. And we're going to get one of those.
We see it here in Canada with real estate, the real estate funds. They never claim to be liquid.
No,
but
now they're gating because they can't provide even the liquidity that they promised they could provide. And that's where, that's usually not a very good sign.
Is that in your other basket, real estate exposure?
Well, if you go back to the total portfolio approach and you look at any return stream, its impact on your total risk and your total return. A lot of times you can look at real estate and you could break it down to the things that you might already own. If you own the bond market, in real estate, there's exposure to what bond yields are doing. If you own the stock market, in real estate, there's generally exposure to what the economy is doing. If you own high yield debt, in real estate, there's generally exposure to how high yield debt is trading. So do you really need to own real estate, or do you already have real estate through your equity, bond, and high yield debt exposure? And that's an important question, because in the old days, we would have these silos. I'm going to have stocks, I'm going to have bonds, I'm going to have real estate, I'm going to have infrastructure, I'm going to have commodities. Now in the new environment, each of these are simply return streams.
So real estate's not in your asset mix?
No, it's an asset mix that it's already part of something that we already have, which is equity and bond and high yield exposure. So do we have real estate broken out separately? No.
Well, let's get an example of that, because I did drag one stock idea.
Yes.
ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. So let's get into that now. I heard you talk about this name, but I'd love to get the thesis and then explain, I guess, how this is an example of sort of like the Picton way, the Picton philosophy. So the company is Rocket.
Yes.
So if you've heard of like Rocket Mortgages, so it's a stock that is a play on the housing market in the U.S. What brought you to that name?
First of all, a shout out to Capitalize for Kids. Incredible organizations, raised a lot of money for very good cause. And at that, you generally highlight a name or two in our portfolio, and we highlighted Rocket Mortgage. And it's really good play on our overall investment process. So we are quantitative on one part of the book, and we are fundamental at the same time. We have a team of fundamental analysts and a team of quantitative analysts. They both go about their business looking for positive fundamental change. The analyst team will go and meet with companies, site visits, build their own models, and the quantitative teams will mine data sources. And if they're both looking for things that are changing for the better and they both overlap, we get really confident in a name. And Rocket is one of these names. So Rocket has had an incredible history of innovation. They were essentially one of the very first companies, they were the first company that allowed you to get a mortgage online. They were the first company that allowed you to do the entire process online. And so they've evolved to being a very big mortgage originator in the U.S. The housing market in the U.S. is about $5 trillion. The mortgage part of that is about $2 trillion. And the top 10 players in that mortgage origination space only have less than 25% market share. So there's a big potential consolidation play. So we came out of COVID, interest rates collapsed, the housing markets went crazy everywhere. We saw that in Canada, but you saw that through all kinds of different areas within the US. And it was heady times for Rocket.
Yeah.
And then we went through the exact opposite. We got into 2022, the Fed's hiking rates, long-term bond yields move up, inflation's here, and the mortgage origination space goes very quiet. Rocket did not go quiet though. So Varun Krishna joined them from Intuit, and very much focused on using that quiet period of time to continue to build their capabilities. And they focused a ton of energy on AI. They're probably one of the very biggest and early users of AI in terms of impacting its business. So they have all this data that they collect, and they're able to kind of monetize that through AI. They also did a couple of big acquisitions. They bought a mortgage servicer. They bought Redfin, which allowed them to get access to online brokerage. And so when they did that, they ended up building a whole ecosystem now. They do mortgage origination. And in the US, they have this amazing feature that if rates go low, you can just go and refinance your mortgage. And you can get the savings directly. You pay a fee to do that. And you pay a fee to Rocket to do that. And then when you buy a house for the first time, you also might go to Rocket to do that. And now you've got Rocket servicing the mortgage too. So what we want to see happen here, and I think is going to happen, is that in each of the big digital areas of the United States, whether it's like e-commerce with Amazon, whether it's online brokerage with, say, Schwab, you get to critical mass, there's massive consolidation, and there's usually a few players left standing, and maybe sometimes only one. In the mortgage space, which is highly fragmented, we think Rocket's going to be that one. And so you can become the dominant player in a market that's been quiet, where you now have this flywheel of origination and service taking place, and your potential for positive change in your earnings growth profile is massive. And all they need is a little bit of tailwind from the bond market to get people refinancing.
Meaning the bond market,
mortgage rates come down. People with higher mortgages refinance, and the whole flywheel kicks into gear.
You just told me you're a little worried about the.
I am. And so
how much does this go down if that doesn't happen?
There is risk in all housing related names. But the interesting thing is that while, say, some of the overall housing stocks have been down more recently, Rocket's actually been kind of perking its head up and actually trading at pretty heady levels relative to what's happening in the rest of the space. There's also the Trump administration, desperate for wins on all fronts when it comes to affordability, talking about different ways of trying to force rates lower or force housing affordability onto the marketplace. Should that occur, again, Rocket might provide you with an interesting exposure to that.
I think that's interesting because the housing market, you're right, has just been kind of stuck. And he is in really unprecedented ways trying to direct that beyond just bullying the central banker.
Yeah.
Directing Fannie and Freddie.
Fannie and Freddie buying mortgage-backed securities.
Like that's unprecedented. Not just more like $200 billion.
It's like quantitative easing for mortgages.
Yes.
Which is very interesting. And it's kind of worked. You've started to see mortgage rates sneak a little bit lower. There's a whole host of people that are now stuck in the U.S. with mortgages above 6%. There is an opportunity as rates move into the fives, hopefully, not saying they will, but if they do, there's a massive opportunity now for this refinancing wheel to kick into gear. And Rocket is very well poised for that.
How quick are you? So you did mention this name in October. That's when Capitalize for Kids was the conference that I was at. Love that conference too. How long are you typically in names? Like I think about hedge funds, I think about maybe high turnover, hedge fund hotels and things like that. Where does Rocket fit for you in terms of time horizon?
Our kind of belief is that when you see the first signs of positive change, the market doesn't necessarily pick up on all of them. Then you see the second kind of major signs of positive change. The market starts to understand. You see the third and the fourth signs of positive change. And usually these are around quarters when they report. That's when the market starts to understand. So our average holding period on many names can be 1, 2, 3, 5 years even. It's just that at the margin, you have names that kind of cycle in and out where your thesis doesn't play out, where the signals that you saw dissipate more quickly than you'd like. So a lot of the portfolio can turn over fairly quickly, and it can change as the environment's changing. You know, when, say, you're getting squeezed on your shorts, you might have to cover a short, you might sell a long on the other side. But when we have a thesis that we think we have an edge on, we want that in the portfolio for a couple of years to try and benefit from it.
And you mentioned AI as a theme and a driver of growth. We've kind of danced around it. Maybe this actually talks about how the AI trade isn't like it was a couple of years ago. But what is your view on the Mag 7? It sounds like, you know, you've said the other 493, it's their time to shine. It's not just about those 7 stocks. I'll ask you point blank, but are you willing to short those 7 stocks? Like, are you calling for big pain in that sector?
We have certainly reduced, and in fact, in some of our portfolios, again, depending on the beta exposure, we actually might be net short technology. And it's not that I don't think AI is real. Everyone knows it's real. It's not that we're not going to see the impact. You're starting to see the impact already of it. But the reality is that over the last couple of years, you just threw money at the AI trade and everything worked. And then we got to a point in time, and I think it was basically when OpenAI's CFO talked about the need for maybe government intervention and that we might be too big to fail. And then you start to look at the CDS spreads, the cost of insuring the debt of Oracle, and they spiked because Oracle's gone all in and has a massive amount of debt that they've never had before.
And big exposure to one client.
Yeah, one client in particular. And you start going, you know what, maybe this isn't just everyone wins. Maybe what's going to happen, just like it did in the internet, is that there's going to be a couple of champions, not multiple champions. And so maybe, and our belief is that this year you go from everything works to now a battle to see who the emerging winners are. And that you start to sort out some companies that maybe aren't going to be in this space versus others that are going to dominate the space. So you can still have some companies that absolutely win from AI and they become the leader and they could go up dramatically. NVIDIA is obviously one of them. They play with every kind of ecosystem in AI. They're a huge winner in this space. But maybe some of the direct players, most of them that are private, maybe it starts sorting itself out and not everyone's there 5 to 10 years from now.
So that's interesting. You view a dip in some of these stocks and we've been trained it's a buying opportunity.
Yep. It might be a buying opportunity in a couple. It may not be a broad-based buying opportunity.
And now there's no FOMO because if I'm not buying Mag 7, it's going down. And my Russell small caps, that's been going up.
Yeah, I think they're like 10 days in a row. They outperformed the NASDAQ here to start the year. There's something different that's occurring.
All right. And we really unpacked it with you today, David. It has been an absolute pleasure to get your insights. Thanks so much for joining me.
My pleasure, Amber. Thank
you. All right. On our next episode, we've got Sam LaBelle of Veritas Asset Management. He'll be taking your questions on North American stocks. You can email us questions@inthemoneypod.com or find us anywhere on social media @inthemoneypod, and we'll try and get some of those questions into Sam. We'll see you on the next episode.